Veritas Investment Research is out with a report that looks at some of Canada's giant dividend-paying stocks, and it isolates those it thinks are poised for robust dividend growth, and those you should be cautious about. Let's get more from Dan Fong, Vice President and Head of Research at Veritas Investment Research. Dan, thank you very much indeed for joining us.
Thanks for having me, Andrew.
I know it's hard to generalize. They're very diversified stocks, but you say that you're looking for stocks with what you call a meaningful yield in general of more than 3% here.
Yeah, that's right. We find that most dividend investors, we're looking for companies that offer some attractive yield, anywhere under that 3% range. Isn't necessarily that meaningful unless you see prospects for further dividend growth or total shareholder return, buybacks, and that sort of thing. But generally speaking, that's kind of the wheelhouse that we look in, and that's the wheelhouse that our clients look at.
Let's get to some of these names that you think are attractive, and there's quite a few here. But we'll start off with Cogeco, if we could, a yield of, and there are the names, ATCO, a diversified provider of buildings and stuff, among other businesses in Western Canada, Granite REIT, Cogeco, CIBC, and Alimentation. Can we start off here with Cogeco? And I'm sorry, I forgot to check. Do you mean Cogeco Communications or Cogeco Inc.?
Communications.
Sure. And what attracts you there to that name?
Well, so our analysts will be able to speak to it much more fluently than I could. But however, from a higher level, what we see here is a reasonable dividend payout ratio. So they're well within that. Debt metrics seemed on par, and they're operating the business quite well from our standpoint. So we're pretty comfortable in terms of the sustainability of that dividend, and as they grow their business, as they continue to execute on their strategies and their capital allocation strategies, we think this is a solid dividend play.
Right. And then dividend lately about 5.5%. CIBC stock has been hitting record highs, dividend yield of 3.3%. That's one of your favorite names. And of course, the banks are they're stalwarts when it comes. I mean, they have a shareholder base that expects regular dividend increases.
Yeah, that's right. And if we look across the entire banking universe, or at least the Canadian banking universe, what we find there is their capital ratios are very, very healthy. So they've got a lot of capital buffer. Each of the banks will have their own specific growth strategies, either U.S. expansion or wealth management and that sort of thing. But having that capital buffer affords them a lot more flexibility in terms of capital allocation. Some of the capital allocation will be reinvested in the business, as I just mentioned, but it's going to leave a fair amount of room for shareholder returns, things like share buybacks and dividend increases. So we see that happening across the board here. I will note, though, that at this point, the Canadian banking space seems to be trading at near peakish multiples for a period where we're entering into some economic volatility, economic uncertainty. But that being said, we think those capital buffers will be very defensive when they need to be, but also they'll be able to deploy that capital in a shareholder-friendly manner.
A name that jumped out first was Alimentation Couche-Tard. The dividend yield relatively low, only 1.2%, but they've been increasing it steadily for almost 2 decades.
Yeah, that's right. So it's a pretty steady dividend grower. And the interesting thing about Couche-Tard is after last summer's failed attempt at the 7-Eleven acquisition, they've pulled back on that. They've got a fair amount of balance sheet capacity to go out and resume their tuck-in acquisition strategy. They've also renewed a share buyback program. And, because they're not necessarily going to swallow up a large giant like 7-Eleven, it affords them, again, more capital allocation flexibility for shareholder returns.
And then among REITs, Granite, you think offers a decent balance sheet and pretty strong prospects for distribution growth.
Yeah, and the balance sheet is really key for that one. That's probably got the best balance sheet, best of class balance sheet, best operating company in that space. Very comfortable with how they operate that business and with that dividend payout ratio. And as they continue moving along, we do see great prospects there.
If we could move on to these are dividend names that you said people should be cautious about, and you stress that you're not in any way forecasting a dividend cut here. But start off with Brookfield Renewable, yield lately about 5.3%. It wouldn't be among your favorite dividend stocks.
No, that's right. And we have a two-person team here that digs into the entire Brookfield complex, Brookfield Renewable being one of those. And what we find at Brookfield Renewable is when we look at that payout ratio, it is extremely elevated. But more than that, when we look at the sustainability of those distributions, a fair amount of that is tied to what's called capital recycling, buying and selling some of their assets. And when we strip out the gains from that and look at an organic cash flow per unit type growth, that cash flow per unit growth is fairly minimal. It's in that 2% type range. So it is very difficult to sustain a 5 or 6% payout or 5 or 6% yield when your unit cash was only growing at 2%. So what this means is, the bet here is more on capital recycling, debt issuance, equity issuance to sustain that distribution.
Just looking at, we're tight for time. I could talk to you about dividend stocks all day. They're so fascinating. I mean, it's been such a great, reliable source of returns over the years. Emera, the electric utility, yield lately about 4.3%. Again, not a dividend stock that jumps out for you in terms of your favorites.
Yeah, again, elevated dividend payout ratio. But more than that, we look at their balance sheet, and they have elevated leverage. And based on our analysts' assessment, what it looks like is in order to sustain their target debt ratio metrics, they may have to resort to additional equity issuance. Typically, when you're relying on equity issuance to fund your debt, that's not necessarily a recipe for dividend growth. And in fact, if we see things turn the other way, then yeah, we would see some risk there.
Dan, thank you very much indeed. Really appreciate it.
Great. Thanks for having me, Andrew.
Dan Fong, Vice President and Head of Research at Veritas Investment Research.